Did you know that just 4% of stocks have been responsible for virtually all of the market gains over the long run? A small handful of stocks has driven most of the market gains in the stock market over the last few decades, whilst the rest has lagged behind. The reason I'm bringing it up is because I only invest in individual stocks, and I'm often asked what is the reason for that, and isn't it too risky? I want to debunk all the myths in this video and show you exactly why I pick individual stocks over investing in boring ETFs. I have never, not once in my life, invested in an ETF or an exchange traded fund. I've consistently invested in individual stocks, and a few big winners is all I've needed to rapidly accelerate my wealth building process inside the stock market. And this is not luck. I've consistently picked out winners for years now. In this video, I'm going to break down my exact strategy for investing in individual stocks, what the performance of those stocks looks like, what the fees associated with them are, and I'm answering the question on everyone's lips: is it risky? Whether you're watching this video from the UK, the US, or somewhere else in the world, you can benefit from what I'm about to say. So buckle in and let's get started. First, let's set the stage for a bunch of different things that we're going to talk about. So firstly is individual stock investing. What do I mean when I say investing in individual stocks? So investing in individual stocks is buying shares directly in a company. So think about someone that buys shares in Apple, for example, or someone that buys shares in Google or NVIDIA or Amazon. You are buying shares and ownership directly in the company that you want, and you have full control over what you're looking to invest in. On the contrary, investing in an ETF or an exchange traded fund gives you access to a bunch of different stocks. Let's take, for example, the S&P 500 ETF. This is a basket of the top 500 companies in the United States by market cap. So that ETF contains 500 of the biggest companies in the US. Now, most financial gurus, advisors, and social media personalities will tell you to invest in ETFs because they're relatively safe and they give you around 7 to 10% every single year. And I'm not going to dispute that. If we look at something like the S&P 500, it has returned around 7 to 10% per annum for years now. Investing in ETFs is safe. There's relatively low fees associated with it. You get diversification and you don't have to monitor it. You can invest on autopilot and it's very, very passive. Investing passively in something like the S&P 500 has worked for millions and millions of people. In fact, studies have been done and show that the majority of hedge fund managers cannot beat a simple index like the S&P 500, and they fail to get the 7 to 10% annualized returns, something like the S&P 500 has been able to get for years now. The numbers don't lie, and that's a really compelling case for why people invest in ETFs. So by now you're probably thinking, why don't I invest in ETFs? If it's so simple, it's so easy, the annualized returns are great, why do I pick individual stocks as opposed to investing directly in ETFs? Well, the truth is there's more to it than meets the eye. And if you've got the dedication, the strategy, and the conviction to pick individual stocks, you can achieve gains that far outweigh what the ETF funds are going to give you. Let me explain how I invest in individual stocks, and every single year, I beat the industry average. Let me tell you a bit more about how I invest in the stock market. See, I'm a long-term investor. I don't do day trading, I don't do swing trading, I don't do anything fancy when it comes to the stock market. I'm very much a set it and forget it kind of guy. I invest in good stocks and I leave my money in them for ages. When I say ages, I mean ages. So I will not buy an individual stock if I'm not going to hold that stock for at least 5 years. And the reason I invest over the long term is because I'm a firm believer that time in the market beats trying to time the market. And anything that I've been invested in for over 5 years is deep in the green. I'm personally not interested in where a stock is going to be in the next 3 months, 4 months, 6 months, even 18 months. I'm interested in where it's going to be in 5, 10, 15, or 20 years. I'm really a long-term investor. And in my experience, the longer I've been in a stock, the less risky the stock has become. The market will always reward those who have patience. And being a long-term investor, you bake in that patience in the stock market. And for me, investing in the stock market isn't just about making money. I actually have a passion for this. I live and breathe it. It's so much more than just numbers on a screen. For me, it's a lifestyle and I live and breathe it every single day. So I primarily invest in US stocks, even though I'm a UK citizen. And the reason behind that is because some of the world's greatest companies are based out of the US and on US stock exchanges like NVIDIA, Apple, Amazon, and Google. These are some of the biggest companies in the world, and they are led by some of the cleverest people you will ever meet. People that studied at Harvard, MIT, Princeton. These are the kind of people that I want to be putting my money in because they are the ones that are going to grow it. And I choose to trust these people more than trusting a pension fund manager who has a pre-packaged list of random stocks that I know nothing about. And for my UK viewers watching this, make sure that whether you're investing in ETFs or individual stocks, that you invest in something that's called a stocks and shares ISA. This is a tax-free wrapper given to us by the UK government that allows us to invest £20,000 every single year completely tax-free. and any money that you make on that £20,000 is void of capital gains tax, income tax, and withdrawal tax. So make sure that if you're investing in a stocks and shares ISA, because if you're not, then you are liable for capital gains tax and you end up paying money that you didn't need to if you had utilized a stocks and shares ISA. And once you've exhausted and maxed out your £20,000 in a stocks and shares ISA, you can then invest in what's called a SIP, or a self-invested personal pension. You can put up to £60,000 every single year into your SIP, and that money is void of all income tax. When you reach the retirement age of 57, you can then withdraw 25% completely tax-free, and for the remainder, you can either choose to draw down or buy out an annuity. If you want to see more about that, check out this video here. Okay, so now we've set the foundations, let's go over why I choose to invest in individual stocks over ETFs. And I'm going to be talking on each of these key points. So number 1 is performance. Number 2 is the control. Number 3 is the focused diversification. And number 4 is the fees and costs associated with ETFs and individual stocks. All right, so by far, the number 1 reason that I choose to invest in individual stocks is the performance that they're able to give me. Now, if you're investing in an ETF, you are literally accepting the average of the market, since something like the S&P 500 is an average of the top 500 stocks in the United States. Now, that's not too shabby because you'll be getting around 7 to 10% every single year. But you will always be average. You will never be above average. You'll never be below average. You'll always be slap bang in the middle, average. But by investing in individual stocks, I'm looking to beat the average. I'm looking to invest in stocks that exceed the average expectations from the market. So stocks that go above and beyond the 7 to 10% average, anyone can get by investing in the S&P 500. Now, ETFs rarely beat the market. By definition, they're average. So investing in them is always going to give you the average. With individual stocks, you're not tied to the pack. You're not tied to the top 500 companies in the world. You're able to select and cherry pick individual stocks that have the ability to go above and beyond what an ETF is going to give you. An example of this is Rocket Lab, which is up hundreds of percent on the year. Investing in individual stocks can give you a much higher upside, and that's the power of concentration over diversification. Now let's break this down with a real life example of 2 stocks that have made me a lot of money. The first stock is NVIDIA, and I'm up over 1200% on my original NVIDIA position that I bought all the way back in 2021. So I was going through a period where I needed to buy a used car, and it was deep in the pandemic. Used car prices have gone through the roof, and I couldn't understand why they were so expensive. So doing a quick Google search, I found out that one of the main reasons why cars were so expensive at the time was because semiconductors had gone through the roof and there was a chip shortage. So I, being a little curious and cunning, I Googled what the best and biggest semiconductor company was at that time. NVIDIA came out on top, and I invested a small amount of money into NVIDIA that has since grown to something huge. I have 2 other batches of NVIDIA stock, and in total, I am up more than £125,000 on my investment. The second company is Apple, and I invested in Apple all the way back in 2010. Fun fact, Apple was actually the very first stock that I ever bought in the stock market. And these Apple shares have made me over £70,000 in profit since I started investing. In fact, that number is actually a lot larger, seeing as I transferred my original Apple shares from a previous stockbroker to Hargreaves Lansdown. So the £70,000 is the money that I've made since they've been with Hargreaves Lansdown. It doesn't include my original profits from my old stockbroker. Now, I'm not going to sit here and lie to you and say that it's going to be easy for you to pick the next Apple, because it's not. But the point is, you don't need to have loads of stocks. If you're investing in an ETF, you have exposure to tons of stocks. But when you're investing in individual stocks, it only takes a few stocks to hit it big for you to change your life completely. As an investor in individual stocks, my goal is to outperform an ETF and get the most aggressive gains I can in my portfolio, and I'm willing to accept a higher level of volatility to get there. The second reason why I choose to invest in individual stocks over ETFs is that I get full control when I'm investing in ETFs. I can pick exactly what I'm investing in, and I can pick how much weighting I want towards that particular stock or asset. When you're investing in an ETF, you're buying someone else's pre-packaged mix of stocks. And as the saying goes, when you invest in an ETF, you're buying someone else's portfolio. The convenience of investing in an ETF is nice. It's passive, you don't have to think about it, you don't have to research into individual stocks, and you can put it on autopilot. That's great. But you are sacrificing control for that level of convenience. When I invest in individual stocks, I have full control of what I'm getting into. For example, at the moment, I'm really looking closely at the quantum space, stocks like Rigetti Computing, IONQ, and D-Wave. And that is somewhere I've put a significant amount of money because I want to grow it aggressively. Now, I would not be able to get the same exposure to those particular stocks if I was investing in an ETF. Another example is nuclear power stocks. I'm looking closely at Oklo and NNE. These are 2 stocks that are growing rapidly within the nuclear power space. Now, I would not be able to get the same level of exposure into these 2 companies if I had invested in an ETF as opposed to buying them individually. And by investing in individual stocks, I'm able to pick the stocks that match my ethics. For example, I might not want to invest in the oil or tobacco industries, and the S&P 500 is littered with these companies. By investing individually, I'm able to pick stocks that reflect my values as an ethical investor. And finally, if I did want to sell and get into something else, I can do that because I have full control when I'm investing in individual stocks. Within an ETF, you have no control or dictation around what that ETF is invested in. So if I wanted to get into companies early on and they're not in an index fund, I wouldn't be able to. I'd have to wait for them to blow up and potentially get into the S&P 500 before I get exposure to them. Investing in individual stocks allows me to do the research and get into companies early on that I feel have potential and get massive wins. Next is focused diversification. So when I'm investing in individual stocks, I'm able to pick exactly what I want to invest in, and I'm able to diversify to the extent that I'm willing to. Whereas when you're investing in ETFs, you almost have too much diversification. You get an average of the market. So the stocks that do amazingly well, like your NVIDIAs, your Googles, they drive the value of the ETF up. But there's also some stocks in there that won't do so well, sectors that are underperforming or stocks that are underperforming, and that is going to bring the average down. So you're always going to get the average. But when I invest in individual stocks, I personally have diversified into 15 to 20 stocks across different sectors that have outperformed the industry average. Therefore, I am focused, but I do have that level of diversification that the ETFs give you. The golden rule here is that you don't want to be too diversified where your average gains are too low, and at the same time you don't want to be too focused where all of your gains rely on a few stocks, and if those stocks get hit, you could lose a lot of money. So find the equilibrium that works for you, but for me it's the individual stocks. Now ETFs are relatively cheap to invest in with low fund fees, but there is some level of fees that are attached to the funds that you're invested in. Individual stocks on the other hand have no fees attached to them. So you can invest in individual stocks completely void of any fees or charges. And investing using a platform like Trading 212, for example, lets you invest with very low FX fees and no commission. And like I said before, investing in US stocks from the UK using a stocks and shares ISA or a SIP means that you don't have to pay any capital gains tax, withdrawal tax, or income tax. However, if you are receiving dividends from a US equity that you hold, you will have to pay a 15% withholding tax that you cannot get away from. Now, I've painted a pretty rosy picture for when it comes to investing in individual stocks, but I would not be a balanced content creator if I didn't give you both sides of the argument, because there are some downsides when it comes to investing in individual stocks, and it isn't all fun and games. So let's get into what the potential downsides are for investing in individual stocks. Number one, and the biggest one in my opinion, is the downside risk when it comes to investing in individual stocks, thanks to the exposure that you have to these individual stocks. Now let's say, for example, we have a situation like we did in April with the Liberation Day tariffs coming out that completely tanked the stock market. Now, if you were invested in the S&P 500, you're always going to get an average of both the upside and the downside. So you're more protected on the downside because you have less exposure to these stocks individually. Whereas if you're investing in individual stocks, you are completely exposed to the downside. Stocks like NVIDIA, for example, went from $140 a share all the way down to $87 a share. Now, me as an individual investor in NVIDIA with over 1,200 shares, I massively bore the brunt of that in my stock account. Whereas if I was invested in the index fund like the S&P 500, I wouldn't see such a massive correction in my portfolio. So ETFs have the advantage of getting the average both on the upside and the downside, meaning that you are more protected if things go bad. Point number two is time commitment. Now, when you're investing in ETFs, you do not have to think about what you're investing in. You simply are just adding units of the ETF into your portfolio every time you buy. You don't have to do any research into the companies. You don't have to think about maybe selling that position and getting into something else. You literally leave it on autopilot, and whoever's running the fund does everything for you. They decide what stocks come in and out, and they decide on the overall performance of the fund. That is both an upside and a downside, but it does mean that you don't have to spend any time researching stocks, looking at potential due diligence, analyzing charts, doing technical analysis, that kind of thing. Whereas when you're investing in individual stocks, this essentially forms the bread and butter of your investing strategy. You have to research stocks that are going to do well, and you have to have a certain level of conviction before you invest in stocks. Now, I spend anywhere between 5 and 10 hours a week investing individual stocks and looking at particular sector analysis. For example, right now I'm looking at 3 sectors: the quantum space, the AI space, and the space exploration space. And it takes a lot of time for me to look into these sectors and do the due diligence research that I need to in order to formulate an argument and case study as to why I should invest in any particular stock within that sector. So there is a level of time commitment that you have to understand if you're investing in individual stocks, and it's something that people who invest in ETFs do not have to worry about. Point number 3 is the fact that there is a risk of underperforming when you are picking individual stocks. So like I said before, within an ETF, you're getting an average of the market. Whereas when you pick individual stocks, you're exposing yourself fully to whatever that company is going to do in the stock market. And things don't always go up. Sometimes you'll pick losers as well as winners. So understand and be willing to accept that risk if you're going to invest in individual stocks. How I mitigate that is I make sure I do enough due diligence and I have enough conviction before I put any money into a stock. And anything I hold in my portfolio is going to be at least a 5-year hold. And I found the longer I've held stocks, the lower the risk is for that individual exposure in that particular company. The fourth and final point is going to be around emotions. So when you're an individual stock picker, you will succumb to both FOMO and panic selling. Now, FOMO stands for fear of missing out, and it's something that I see very, very often. All too often, I'll get DMs from people asking what I think about this company or that company and whether or not they can still invest in them given that they've had significant gains already. As an individual stock investor, you have to understand that you cannot win them all. You cannot get into every single stock that's going to take off. And that's not what we want to do. We don't want to spread ourselves too thin. We don't want to have a huge portfolio of 100 shares and not have enough money in each of them to make significant gains. Understanding that you won't get into everything will protect you from FOMO. In my opinion, you should never FOMO into a position. You always want to make sure you understand the risks involved with getting into a particular position and only get into stocks that you have 100% conviction on. I'm comfortable with the fact that I will not own every single amazing stock that's going to do crazy in the stock market. And I'm okay with that. I've come to terms with that. A lot of people haven't, and they get themselves in trouble by FOMOing into positions and then losing when the stock comes down or corrects. Panic selling is the other phenomenon I see a lot of people falling victim to. Getting into a stock and then selling it when it goes down 10, 15 or 20% because you panic and you've never been in that position before. See that all too often, and that is a telltale sign of a newbie investor. For those of you who follow me on TikTok, you'll know that I joke around and say that I suffer from CSS, or can't sell syndrome. And that's because I'm a long-term holder of stocks and I tend to hold them longer than the average person and almost never sell. And that CSS or can't sell syndrome condition has stopped me from panic selling multiple times. But the truth is, I invest like a business owner. And if the fundamentals hold true, I don't get shaken out by short-term market fluctuations and keep my position. ETFs or exchange traded funds are safe and simple for the average investor. If you're a beginner and this is your first foray into the stock market, you don't have the time to invest in individual stocks and you just want something that's going to give you an average return every single year and protect you on the downside, then this is the type of investment that you'll probably be going for. Individual stocks are riskier and they require you to have the ability to research into them, but they give you extraordinary gains. I would never be able to be 1,200% up on an ETF like I am with NVIDIA. So if you understand the risks and you're willing to take them on, you can make extraordinary gains by investing in individual stocks. I invest in individual stocks because I want to maintain control of what I invest in. And at the end of the day, I want to be responsible for the money that I make in the stock market. Investing in individual stocks gives me the ability to beat the mediocre gains that you receive by investing in an ETF. And I use ISAs and SIPs to make sure that all the money I make is wrapped up completely tax-free. Plus, this is the exact approach I take for a 2-year-old where I control their junior stocks and shares ISA. If you want to see more on that, click the video here and I'll see you in the next one.